Ironically, it's not necessarily the debt ceiling to focus on, it's what happens right after it. When they resolve that debt ceiling and the Treasury tries to raise their cash balance back to their normal target level, that's a huge liquidity withdrawal
Yep.
out of the financial system that is already very tight on liquidity. So, autumn of last year basically was kind of a partial turning point in liquidity because for most of last year, you had the Fed drawing down their balance sheet, and that was obviously pulling a lot of liquidity out of the market. But then starting in the later part of the year, you had the Treasury really begin to offset that to a significant degree. They were pushing liquidity
Mm-hmm.
back into the market while the Fed was pulling it out. And so you actually had somewhat neutral liquidity conditions overall, kind of this choppy sideways, kind of stagnant liquidity environment. And if you get to the end of that, where the Fed is still trying to draw down, and now the Treasury is trying to refill its account later this year, that's a double negative whammy for liquidity.